Good evening, Ajay ji. Um, Dear audience, I'm very happy to introduce Mr. Ajay Bagga. Is having more than 3 decades of experience in Indian financial industry and is one of the most respected experts of the Indian financial industry. Has led institutions across all its sectors and worked with global leaders like Citigroup, General Electric, and Deutsche Bank. He was the youngest CEO of the mutual fund industry at the age of 36, heading Kotak Mahindra Asset Management and Lotus India Asset Management. He has served on various financial industry committees and think tanks and has been the chairman of the Financial Planning Standard Board of India. He is a regular contributor to the electronic and print media with more than 1,000 TV appearances and 100 articles. Congratulations, sir, for your great achievement. For the last 2 decades, he has been associated pro bono with the Art of Living Foundation. Sir, thank you for accepting our invitation and addressing and ready to answer the questions to the various students and the audience and the people from the finance industry. Sir, I'm raising the first question. Now, this is everywhere they talk about the corona. And the first question is that the global economy was on a slowdown already. You know that. Do you think this coronavirus has pushed it on the path of global recession? We saw one recession in the post 2008 Wall Street crisis, and now barely after 10 to 12 years, we are encountering another one. It will be great to have your insights into this, please.
Thank you, Dr. Subbarao, and thank you very much, Rishi University, for the opportunity to address all of you today on a very pertinent subject of the impact of coronavirus. If you look back for the last 40 years, in 1987, we had the Black October crash in the US market. We had the long-term capital management hedge fund blowing up, and nearly the entire financial system of the West was at risk, and the regulatory authorities acted swiftly to take care of that crisis. Come ahead 10 years, 1997, 98, we had Mexico, we had the Russian crisis, and the mother of all of that decade, the Asian financial crisis, where a lot of the Asian economies and currencies melted down, and again a huge stimulus, a lot of IMF intervention was needed to salvage the global economy. From there we came to 2008, the global financial crisis, which started with a tightness in the money markets, a couple of hedge funds blowing up, and then all the excesses of the previous decade in terms of the subprime, in terms of over leverage of banks, resulted in a very big financial crisis, which got labeled the global financial crisis. And now, today in 2020, we are staring at something which has come to us from the real economy. It is unlike 2008, which was more of a financial markets crisis. Now we have a real economy crisis in terms of the coronavirus-induced pandemic and the subsequent impact on the global economies. So this started with China. Around January 21st is when China publicly acknowledged that there is a raging virus which is infecting large parts of the Hubei province, especially the city of Wuhan. Very strong measures from China led to some containment, but overall, if you look at the Chinese economy, it nearly went down by 50% to 25%, depending on the sector you look at. Automobiles went down 79% year on year. Services from a PMI number of about 54 came down to 29. Manufacturing from about 50 came down to 35. And as a comparison, at the height of 2008 crisis also, the manufacturing PMI had gone down to 38, 39. It had never hit this 35 level. services had withstood even in the global financial crisis. So it became a huge supply issue in the Chinese economy. The big difference between 2008 and now, or the previous epidemic, which was of this scale, SARS in 2003, was the scale of the Chinese economy. Today, China is manufacturing 28% of the global manufacturing of goods. In terms of exports, if you look at, it is exporting about 35% of global apparel, nearly 40% of global electronics, huge amounts of intermediate and capital goods to the global economy. And it is both a receiver of commodities and intermediate goods, as well as an exporter of finished goods. So just the sheer scale of China shook up the global economy. The other big issue that we are seeing is that that supply issue became a demand issue very fast because of the lockdowns that happened in the Chinese economy. And with those lockdowns, there was no demand for services, there was very little demand for manufactured goods. And we saw that the Chinese economy has probably contracted. So from a plus 6% expectation for the first quarter, we are expecting anything from -4 to -8% for the first quarter. So that is as far as China goes and the advent of the virus. What was different this time was that the virus had a very large incubation period. Also, it was able to transmit within communities, even from seemingly unaffected people. So people who would not have any symptoms could be carriers of the virus. And before we realized it, it had reached about 150 countries. Two more epicenters came up. One was in northern Italy, which was linked to the leather trade and the textile trade with China, and with a lot of Chinese workers coming during the lunar year. And all of a sudden, Italy, which was very unprepared, became a new epicenter. And second was Iran, where again, a lot of pilgrims going to Shia pilgrim centers were affected and probably were carriers of the virus. And Iran again became an epicenter. Where we are today, Europe has very alarming numbers of infections and deaths. They don't have the scale of healthcare. They have very high quality healthcare, but in terms of sheer scale and magnitude to handle the way China was able to handle will take time. US is starting to get infections, especially it started in Seattle. Now Ohio is talking about maybe 100,000 people infected. Germany said maybe 70% of the population will eventually get infected. So all that is leading to a huge erosion of consumer sentiment. It's leading to a large supply constraint, and it's leading to a huge demand gap as people are just shutting down all non-essential activities. And now countries are locking down borders. Italy has locked itself up. Spain has done that. Germany is looking at it, will probably announce it fast, and France has already done that. So major countries, major economies are now on lockdown mode. The first sectors that got the maximum impact were transport, aviation, tourism. We saw the gaming revenues at Macau, for example, went down 80% year-on-year. Tourism went down. Expectation is that most major airlines, which are only international in nature, will see a 70 to 80% fall in number of flights, if not just get grounded totally. Already we have had one bankruptcy of an economy carrier out of Europe, which has gone bust. but there will be many more. And then the suppliers into all these airlines, the Boeings, the Airbuses of the world. A concomitant impact was on the oil markets, where OPEC plus, the agreement between the Saudis largely on one side and the Russians to reduce the supply, that fell through in Vienna about 2.5 weeks back. And the Saudis decided to flood the market with oil so as to bankrupt all the producers, something they did very well in 98, something they tried in 2014 and failed. Now the same game is on. It's anybody's guess, but oil prices are down nearly 50%. Brent has gone from about $60 to $30. And same for WTI, same for Dubai crude. All the markers for the oil markets, which is normally very, it is a predictor of weakness in the global economy. Already China was taking less of oil, and there was an oversupply. In that scenario, nearly 1 million barrel more per day starting March is really threatening the overall oil economics. We have seen a downgrade of ratings of a number of producers in the US, especially the shale producers, are on very high leverage levels, and they need, if you look at the levels at which various producers are producing, Saudis have the lowest cost of about $10 per barrel. Russians onshore is costing about $45. US shale is about $50. India is at about $55 to $60. So unless you make that much, you're really not getting what you are putting in producing that barrel of oil. And if the Russians are forced to sell at 30, they will have a big fiscal deficit. Good thing is, over the last 6 years, they have built a huge oil reserve, just like the Norwegians have the Sovereign Wealth Fund, which is now the biggest in the world. Same way the Russians have built a huge reserve. And for some time, they'll be able to withstand. The Russian minister has said, for next 5 years, we are okay. Probably both will play out till the US shale is bankrupted and that capacity goes off. And then you will see prices rising. So looking ahead, first quarter global economy will stay flat at best, because apart from China, the impact was not so huge. But now March onwards, the impact in Europe, US is starting. So our expectation is second quarter global economy contracts. Some countries will go down as much as 10 to 20% year-on-year contraction. The US expectation is about minus 10% for the second quarter in terms of the calendar. And third quarter, you will hopefully start seeing, if the virus is under control by then, slowly the world will have a flat quarter. And fourth quarter, we are expecting some kind of a tepid recovery, maybe a 2% growth again. So that's the summary about where the global economy is right now.
Sir, how do you think India will be affected in this process? Now we explained in the global context, but the Indian context, what measures Indian government will take to minimize this impact?
Very, very, very pertinent question for all of us. If you look at India, we are very much linked into the global markets. As an economy, we are low beta, low risk, because our trade linkage to the global economy is very small. We, as against China being about 28% of global manufacturing, we are just 3%. So we are, though we are in the top 10 economies, but with respect to China or US, we are much smaller. We don't export that much. Our imports are largely oil, and nearly $120 billion out of 500 billion of our imports is oil. So that way, we are not that dependent on trade per se. We are a domestic economy. we should be able to weather this quite okay. But we have the second order impacts coming from a global slowdown. One is capital flows. We have seen nearly 30,000 crores plus going out of our markets in March itself. Uh, Overall, in the year, about $4.6 billion plus has gone out already, and more is expected. Flows will turn negative. That has an impact on the rupee dollar. That has an impact on overall sentiment in the economy. We are facing a slowdown already. The economy was not in a great shape. It was growing at 4.5%, 5% in real terms. WPI is down to 2.6%. So overall pricing power is lacking. There is a lot of output gap, which means there is a lot of idle capacity in the economy. We are using about 70% of our capacity. So already we had all these troubles facing the economy. There's a big fiscal gap. If you see, fiscal deficit at center plus state levels would be roughly about 9% already. So, that does not leave much space to the government to intervene in a fiscal sense. But what we are seeing is that the government is doing a great job top down. Firstly, they have put this on priority. The Prime Minister himself, in his address to the SAARC nations and all the initiatives he's taking locally and globally, we have put this on our very high priority to contain this virus. The awareness is huge, and the whole government machinery has been activated, and a lot of NGOs are working towards that. So that's one. Second, what we are expecting, RBI has done 2 or 3 liquidity measures already. Dollars are in short supply globally. RBI has started pumping in dollars into the Indian economy by doing dollar-rupee swaps. Plus, they are generating rupee liquidity, nearly about 3 crores. They have pumped in on a daily basis in terms of liquidity. And more has been promised in the last RBI press conference also that the governor addressed yesterday. So government is looking at a comprehensive response. Our expectation is for RBI to cut rates and generate more liquidity. What will be needed is first giving a loan deferral to all debtors in the economy, both corporate and individuals, because the way cities are going on lockdown in India, and there will be huge job loss as businesses, small businesses are not able to function, restaurants shut down, construction work stops, all kind of will stop as we go into shutdown, and government will have to bail out those people. So some direct benefit transfer to the unemployed, to the farm segments, we expect that. So a bigger fiscal stimulus along with a monetary stimulus from the RBI in terms of rate cuts and more liquidity into the markets. That's what we are expecting.
Okay, sir. Compared to China, the effect on India is less because India's role in the global economy is little. So the most important, recently, the Prime Minister Narendra Modi has given a call for regional solidarity in South Asia and has proposed a $10 million fund to tackle Corona in the region. How do you see this development? It's having any positive impact on India?
No, it's very good. And in fact, if you see the Jaipur treatment of the patients, so Indians put a combination with chloroquine basically, along with Tamiflu, the drug for swine flu, and along with 2 drugs which are used to treat autoimmune disorders, HIVs. So the combination of these 4 drugs has worked very well, and the patients have recovered. So India, with its very knowledgeable and educated doctor cachet, can really contribute a lot to the world. Government has allowed a lot of research to go on. Two Indian companies are in fact making chloroquine phosphate clinical trials in India. And we are expecting that if that inhibits the spread of this virus, it can be a major discovery. So that is on the Indian medical side. The Prime Minister is giving a very statesman-like leadership to the whole region, and providing direction, especially to our smaller brothers and sisters in the neighborhood who could get overwhelmed by the challenge, given the scale of our healthcare system. And remember, we have lakhs and lakhs of cases every year of malaria, of flu, of dengue, of tuberculosis that our healthcare system is able to handle. TB, for example, we have the village level primary health workers who are going and giving the medicine on a regular basis to the patients and ensuring that in their presence the patient is having the medicine. That kind of network that India brings, I think we'll be able to help out a lot of our neighbors with it. So kudos to the government on all the steps they are taking, and great leadership by the Prime Minister on this front.
Sir, there's one question. You have already explained about the oil reserves and the OPEC role, but the oil prices have gone down. At some places around 40% less. India is now keen to store strategic reserve of oil. Many argue that Modi government should pass on the benefit to the consumers. But the government has increased the excess duty on oil. What can we understand from this?
See, price of oil is made up of about 4 components. One is the crude oil itself. So at the well, then you add the shipping cost. So what is your landed cost of oil? Suppose that is at $32, $33 today for us. After that, you have to add on the refining. So the gross refining margins of $5, $6, you can add that. Those are the normal GRMs. In the Singapore GRMs, we see anything from $3 to $8, depending on the complexity of the oil. And then you have marketing margins for our refiners and the marketing companies. We have local level taxes by the states. We have the central level taxes. And oil remains the single biggest revenue source for the government after direct taxes and after corporate taxes. So the third or fourth biggest generator of revenues for government is oil. Should the government pass on the whole savings? I don't think so. I would rather go by the Norwegian model, where despite being a big producer of oil, they have saved that money, and by keeping the oil price at about $9 in the local economy, what they have done is that they have made the local industry efficient. The renewable industry can become viable if the fossil fuels are the largest sovereign fund in the world, which is again, able to provide a huge support to all Norwegian citizens. So I think that's what our government is doing. They're not passing it back, so that the industry and all people look at productivity enhancement measures. Second, we have a huge renewables mission. After China, India has the biggest objectives in terms of renewables, both by the Paris Climate Accord and overall. Solar is our petchem, given that we have nearly 320 days of sunlight and most of India has more than 300 days. Solar can become very big. We have a lot of wind available and hydropower. We have a lot of potential. Given the huge coastline, the way both offshore solar as well as the tidal power is being harnessed globally, I think that can become a big thing for India. So I am not expecting much of a cut, though today the aviation minister has spoken that they will give airlines some support in terms of lower aviation fuel prices, which is good. That's an industry in big trouble with the virus issues. So any stimulus into that industry is much needed. We have to protect it like an infrastructure industry. So the government, be it on the AGR issue on telecom, be it on this aviation issue, wherever it's required, they are giving comfort and support, which is good. Blanket way of passing on this price, I don't think that's the objective of this government. They want to keep the oil price high so people use it productively, because we are importing 83% of our oil. So, it is national wealth that is going out every time you're taking your car out, every time you're using oil, diesel, all the crude intermediates. You are actually spending the national wealth. So making that as much self-reliant and as much streamlined as possible would be the bigger objective of the government.
So next I want to ask one question. Many of the audience are interested to listen for this. Markets around the world have been volatile. Indian Sensex has gone down from 40K to 30K in a matter of days. Many people are panicking. And what advice would you like to give to them and to our students who are keen to invest in the time of Corona?
Well, every crisis is an opportunity to learn. And as I told you, we have seen 87, we have seen 97, we have seen 2008, 2020. We also saw dot-com bubble burst in 2000. There have been many crises, 2011-12 European issue, European debt issue, the Greece issue, Brexit. So a lot of crises keep coming. Markets are cyclical. They oscillate between fear and greed. They oscillate between being overvalued to very undervalued, very optimistic to very pessimistic. Right now, we are entering the pessimistic zone. After 11 years globally of great markets and great economy, now the cycle is turning. It won't be easy. It won't be short. I am personally expecting anything from 6 months to a year of downdraft in the markets, where the markets will fall further. Last night, one of the best value investors, Mr. Howard Marks, he was on TV and he said probably 60% of the fall is done and 40% more is left. But value is emerging. So if you like something, you can start nibbling at it. My personal feeling is you can never call the bottom. Only after a year we will know that, oh, this was the bottom of the market. Secondly, within a bear market, you have very sharp rises. Most of the record-breaking rises of markets come within a overall bear market trend. So you might have one day of 3-4%, 5% rise in the market, followed by another sharp fall. So these fall starts keep coming. What we are telling investors, one is your existing portfolio, maintain that. This is not the time to sell. Maybe prices will go down another 20%, 30% from here. Nobody knows. Maybe the market turns. Maybe tomorrow there's a wonder drug which comes and sorts out the coronavirus. You all of a sudden realize that if you give quinine, the virus does not get transmitted. Maybe that comes in. We don't know. We just look at history to see what is possible, what is probable. Most probable is you have 400 days to 500 days of a slowdown in the economy. Markets will pick up before the economy turns, because markets are discounting mechanism. Markets are always forward-looking. They discount the future much more efficiently than any of us can see. Markets will turn ahead of the economic turn, that is for sure. But we might have 6 months to a year of pain ahead of us. So fresh capital, I would say, first look at all your liquidity needs, what you will need for the next 1 to 2 years. Keep that aside. After that, start allocating it regularly, not as a lump sum. Uh, Even if markets go down another 20%, I would still not change my view of saying, okay, now you put in everything. One exception to this rule would be that if you have studied a company, you really like a company, you are very assured of that management, that kind of perspective, yes, then go ahead, put in a lump sum and be willing to wait out 3 years, 5 years, whatever it takes to generate your financial returns. That's how I would recommend. Bear markets, don't give up, because when the turn comes in the market, then the rise will come in a matter of days. And if you're left behind, you will not catch that rise. So stay invested, existing portfolios. You can take out the weeds, companies which will never come back. Every bear market, you have those companies which become scorched earth or weeds. Just sell them off so that it's not an emotional scar on you that I made this mistake. Forget that mistake and move on. Take those lessons to heart, but don't let that mistake stay in your portfolio. Water the flowers in your portfolios and keep looking for the next flowers. That's the small mantra for bear markets.
Thank you, sir. Thank you very much. So this corona has affected the three major centers of business, that is China, Europe, and United States. Let me read the recent headlines of the global news platforms. That recently the CNN news channel has said that the global coronavirus recession is beginning. And the Economic Times said global economic coordination has not happening in virus crisis. At the same time, same day, New York Times said markets plunge as a global recession appears almost inevitable. And Bloomberg said on the next day, is the coronavirus impact on global economy bigger than 2008 global financial crisis? It is a little contradicting confusion statements because all are reputed financial journals or the times they are saying that. Then what is your take, sir? What is your opinion on this?
See, firstly, I'll say nobody knows, because we don't know how soon this virus will get contained. China is a very good model. Korea gives a very good model where they tested nearly 20,000 people per day. And within 12 days, by testing 250,000 people, they could contain the virus. No other country apart from China and Korea has done on that scale. Singapore had a different model, again very successful, of isolating people, very disciplined population, tracing out contacts for every infected person and isolating, quarantining, and they were able to contain it to 200, 300 numbers. Taiwan offers a great model again, where despite being 81 miles from China, having millions of Chinese visiting it, middle of the lunar year, by very strong top-down measures like India is taking, they were able to ensure that they didn't have an outbreak of that large a magnitude. So there are these success models. Each country will have to develop a hybrid of this. So we really don't know whether, if this, if the Chinese model is followed, in the next 2 weeks, you will see fresh infections flatten in Europe. And then in 4 weeks, you will see Europe tapering off. US will peak in 4 weeks, and in 6 weeks, you could see flattening in the US as well. So really, we don't know. As I said, some magic drug might come up. They are trying the swine flu drugs, the SARS drugs, the malaria drugs. Combinations of them are being put in. Combination with phosphates are being put in because those inhibit the virus from reproducing itself. So a lot of clinical trials are on. Anything can happen. What we have to see, what is the broad probability? Broad probability is the virus gets contained over the next 3 months. Economic impact stays for 6 months to 9 months. Markets recover in about 6 months to 9 months. That's the broad, probability. but anything can happen. It can go on any tangents here. So for us, success mantra in such times is conserve capital, stay in cash. You've seen, normal safe haven assets like gold and silver started falling also. Gold, largely because people were over leveraged, margin calls came in, and they were sitting on profits from last year. Gold was the top performer for last year, and we saw that coming in. Is my voice coming, Professor Subbarao? Okay.
It's coming.
Yeah. So we saw gold sell off, all the way from $1,650 to about $1,450. Very surprising. So every crisis teaches you something new. Silver, we were expecting to fall. It's gone back to 2008 levels, because silver is used both in jewelry as well as industry. And when industry is slowing down, silver will go down. And silver behaved like that. So some surprises, something that you look back and say, oh, why did I miss this? I should have seen this. Something you say, aha, I knew it was coming. But right now, issues are becoming second order. Virus will get contained, but the sentiments that's getting spoiled. Philippines, for example, today shut down its entire financial markets, stock market, foreign exchange market, and local bonds market. It just shut down everything. It's looking like short sales will be banned in some European countries, as happened in 2008, 2011, 12. Korea has banned short sales. China has banned short sales in its market already. Japan always buys its own stocks. Bank of Japan day before mentioned that they will be putting $112 billion more into ETFs which own Japanese stocks this year. So various responses are coming out, but what that is showing is credit markets, which are huge and which are very heavily leveraged, especially the junk bond markets, those are coming unstuck. Combination of virus, combination of supply demand issues, economic slowdown, sentiment going down, and overall expectation that the economy will go into a recession. What are the markets pricing right now? We look at the VIX, which is the volatility index. Last night, the US VIX went to 89 levels. The highest it went in even 2008, when the markets fell 60%. It had gone to 82. So the volatility, the perceived risk has already topped out. Markets, have they bottomed out? I don't know. And the best investors will tell you, nobody can tell you. Don't believe anybody who says, yes, this is the bottom. We don't know, really. Most probably, it goes down another 30 to 40% from here on the lower levels. So not from the top. You've lost, say, 20%. You're down to 80. Another 20, 30%, 40% of that 80 is what you will lose. So maybe 20, 25% more. That's the most probable. If the virus is tackled soon, given the huge stimulus all central banks are putting in, all governments, today we are expecting US to announce a huge payroll tax cut of the order of $950 billion. So nearly $1 trillion. Fed has put in $1.5 trillion into its money markets. Fed is putting $700 billion into buying US treasuries and mortgage-linked securities. They have cut rates to nearly 0%. And across, France today announced 45 billion euros. UK last week in its budget put aside about 12 billion sterling just for virus-related relief for their economies. So all this will get together, set the platform, and then one day the market will turn. We don't know when it will turn. So slowly we keep investing and we wait for that day. That's the success mantra.
Thank you. Thank you very much, sir. Sir, few of audience are online. They have sent their questions. Can I ask a few more questions, sir?
Sure. Nothing on particular stocks.
No.
On, yeah.
On the economy itself.
Yes, sir.
one of the Mr. Ronak Kumar Agarwal is saying that stocks are crashing, banks are merging, gold prices are rising, inflation is rising, and countless volatile disruptions are happening in the financial world. Being a part of material world is happening. In such a situation, what strategy shall India take to have sustaining growth and steadily raise to achieve $5 trillion economy? He's talking about the how to achieve in this time the 5 trillion economy.
Very, very good question, Mr. Agarwal, and no simple answer. But the best minds in the country, in the government, are working on this. I don't think now 5 years, 5 trillion will happen because this virus will derail the global economy. We will also have to go through that. We can't help it. It will be a combination of monetary measures from the Reserve Bank in terms of cutting rates, in terms of releasing liquidity, fiscal measures from the government of providing relief to affected sectors like aviation right now, like tourism. Airport operators globally are suffering because if you had 70 million passengers a year, now this year you will probably look at 20 million, 25 million going through. There's going to be a huge fall. Automobile players will suffer. All the suppliers into automobiles will suffer. So there's a huge number of sectors which are going to suffer. Consumer sentiment will go down. So at this time, the best response, as I said, in 2008, China put about 9.7% of its GDP in terms of stimulus into its economy. And China actually led the whole global economy back on the path of growth in 2008, 2009. This time, everybody knows those answers because 2008 is very fresh in people's mind. Asian financial crisis, very few people like us are around who remember that, who went and bought companies at that time at very throwaway prices. 87 is largely forgotten. It has become history. Very few people remember LTCM and the Black Friday and all those things. So 2008 lessons are what? Do things in a coordinated manner across countries. Second, act early, act fast, and give substantial stimulus in the beginning of the downturn. If you see the Fed, they have cut 1.5%. Following them, entire Gulf has cut, Hong Kong has cut, New Zealand, Australia, most of Europe. Europe was already in negative rates. They have increased the stimulus. UK has done a big cut of 50 basis points. India, we are expecting a cut anytime now. So people will coordinated manner, convergent manner. They will all talk up the economies, boost the sentiments, and help the So that's what we are expecting. Inflation, we don't expect it to go down because, the commodity prices, the way they are going down, they have reached about, roughly 50% of their peaks. So it will take time because demand destruction is very pervasive. So inflation, we are not afraid of. Growth is what everybody will be searching, and India will provide one very attractive destination where you can invest and look at growth in a country where there's rule of law, there's protection of contracts, a good bankruptcy code also, and a very progressive industry to set up here, both at the center as well as the state levels. So we will get a large share of that money as it starts flowing. Years 5 trillion is difficult now. You need to grow at about 10% to reach that, which we'll not be able to, at least for the next 1.5 years.
So there is one question relating to the startup valuation. Mr. Prashant Singh is asking, what are all the reasons for the GDP growth? Slowdown.
Professor Subbarao, I lost you there. The voice was dragging. Would you repeat? Repeat the question.
Yeah, Mr. Prashant Singh is asking a question on that. What all are the reasons for the GDP growth to slow down so much? Certain experts claim government inefficiency. Please enlighten on whether this downward trajectory can be startup valuations will come down. Will this change the model of the startup ecosystem itself to value creation, not just valuation?
See, first, the latter part of your question, startup valuations will not come down, because in the unlisted space, in the private space, even today there is $3 trillion globally, which is unallocated, which is looking for growth opportunities. What we have seen from 97, from 2008 for now, that there is a temporary blip, maybe 3 months people will stop investing large monies. But then all of a sudden, there'll be a lot of discovery of values as sentiment goes down and money will rush in. So startups will find it tough, the real startups who are just starting off now, but existing unicorns, existing startups will grab market shares. They will go and buy more, mergers will increase because there is enough liquidity. This crisis is more a real world crisis than a financial crisis. 2008 was a financial crisis. We didn't know where is liquidity coming from. That also got sorted by about 2009, within a year. This time, this huge liquidity. Central banks are still printing money overnight. So unlisted space, I don't see that big an issue. Listed space will take time. This is a correction. It will go into a recession and then it will turn. What we have to ensure is through fiscal and monetary stimulus that correction to recession doesn't become a depression, where it goes down very massively as happened in 2008. So we have to avoid the depression, which the lessons are well learned by all the central bankers and all the governments, not expecting it to go into a depression. Coming to causes for India's economic growth slowing down, 3 or 4 major factors. One was the huge NPA problems in banks. So, liquidity is like the oxygen to the economy. We had a seizing or a seizure of liquidity because we had 9 lakh crores out of 80 lakh crores at that time of bank lending. Nearly 9 lakh crores was bad, recognized bad. Another 7 lakh crores was restructured, which was just a euphemism for kicking the can down the road. You had restructured, but money was not coming back. So nearly 22% of your corporate lending was bad. So you had a double balance sheet problems where banks didn't have money to lend, they didn't have capital to put on new assets, and companies were over leveraged. Promoters had done crony capitalism with bankers. They had stuffed their project reports and taken more money than they could handle. You had steel plants, 40,000, 50,000 crores of loans, and the project cost was nearly 60, 70% of that. And that was pervasive across the economy. That has taken 6 years to clean out. RBI has done a great job, but that has stalled growth. Second was the shadow banking crisis, which happened with ILFS going bust in September of 2018. And that just led to seizing up of the credit markets as far as the NBFCs or shadow banks. And shadow banks were providing 30% of incremental credit into the economy. That 30% became zero. So even if the banks grew their 70% of the pie by 10%, on 100%, it became only 6-7%. That is what has happened, which again, curtailed our economic growth. These are the 2 very big factors. Apart from that, lack of fiscal space, because our tax revenues are just not enough. GST, people found loopholes faster than the government could catch them. So you had GST, which was very stagnant and a very complex system. You had short-term impacts of demonetization, 86% of the currency going out overnight. That stalled the economy for about 6 months and brought it down. But on a 2-year, 3-year basis, it had very good second order effects of financialization, of formalization of the economy. Good things that have happened: GST, bankruptcy code, Make in India, Startup India, all the social benefits that the government was able to deliver. 8 crores of new gas connections, millions of toilets, millions of houses, millions of uh, uh, village level pakka houses, hundreds of kilometers of highways, railways modernization, railways broad gauging, railways electrification, renewables a huge amount. So a lot of base work has been done by the government. Now we have to build up the superstructure on it. We'll need another 5 to 10 years for this to come out and to take India into a middle income country level. But it's happening, So irrespective of what happens on the central stage or state governments, whichever government is there, you will see that this is now inexorable. It's historic because that base has been formed and now it will unleash. So I'm very positive on the economy. There are issues. It's not an easy country to run, and we have huge challenges with our caste identities, religious identities, all those things getting paramount at times. But the development agenda is there for every party, and that will flow, and that will help market also to do well.
Sir, one more last question from my side, from a student of management studies. He's asking a beautiful question. A lot of us, as millennials, are in our first jobs. How do you recommend us to handle this economic slowdown in regard to the changing of jobs across sectors at this moment? They are the first time entering into the job market. They are asking that your recommendation, shall we continue or we can change across the sectors?
See, unless you hate your job very much, I would say please look at your career as a 30-year, 40-year career. You must have something to show at the end of, say, next 5 years. If you keep changing jobs every 6 months, 1 year, you will have a lot of thrills, but you will have nothing to show for yourself. So you have to engineer greatness for yourself, take the toughest projects, work the hardest. Good thing is, if you take something that you like and you get something that you like, you're very lucky, then it's not work at all. Most of us don't fall in that category. It takes a long time for you to be financially independent or to find your bearings. So what you have right now, look at that from a perspective of, if I was writing my CV 5 years from now, how would I position this? And then go for all the facets of that job, which you can do with towering competence and gain those skill sets. There's a lot to learn from any job. No job is small, and you can make it as large or as small as you want. When you start as an entry-level management officer or management trainee, it's not that the company will give you all the strategic work, but take the tough jobs. Sales, for example, is a very tough job. These days, digital, analytics, data, big data, machine learning, all these are jobs where you can't find enough people. So whichever industry excites you, whichever function excites you, try and grab that and get the most out of that. Don't be in a rush to keep changing jobs. Grass always looks greener, but the same monsters are sitting in every organization. So the monsters are there in your head. You have to tackle them. That will come with age. Very difficult to explain that patiently to you today. to take a 30-year perspective. You will take some knocks, make some mistakes. Earlier you make the mistakes, better it is, because the cost is lower. If you make same mistakes at a higher level of your career, you might not be able to recover for those. So right now, make the mistakes, everyone will forgive you, and take on the tough tasks, take on the projects, make a name for yourself. And after that, if you want to do entrepreneurship, go and do your startup. There is capital available in the world for good ideas, for disruptive ideas. Keep that also at the back of your mind. That's the difference between you and what we were 30 years back. There was no capital, and the technology was not so pervasive. It took another 15 years after Y2K that really the technology boom started in India. For you, you have that platform available. So make the most of it.
Thank you very much, sir. You have shared a lot of information. Thank you, one and all. But the
Yeah.
forum
now, Professor, any questions from the participants?
Yes, sir. Yes, sir.
Anybody would like to ask?
You can unmute yourself and ask the question. Any viewers?
If people can just introduce themselves, we can unmute, and I'll be happy to take a couple of questions.
Sir, Madam Rupa Vora is raised her hand. She want to ask some question to you in that.
Madam Rupa Vora should ask the question and give the answer also. We have to learn from her, or we have to answer her question.
Ajay Bagga, I think it was a superb, very comprehensive roundup of what we can expect. Thank you so much for that. It's always been a pleasure listening to you, and you have a wealth of knowledge. We are lucky to get it all in 1 hour from you. That said, and looking at the erosion of the consumer sentiment, countries locking borders, the disruption that the coronavirus has caused is overwhelming. And while I agree that loan deferrals is required, do you see the NPA problem escalating further? And while Yes Bank has seen a bailout, and hopefully tomorrow we'll see it operating one more time, do you see that coming ahead more? And does this also give an increased scope of opportunity in the distressed asset space? I wanted your comments on that.
Yep, absolutely, Rupaji. And if you see both in the US, European and Indian markets, what has fallen the most are the financial services and mostly banks. Because you're spot on with your experience. What will happen is retail debtors will get laid off, will not get paid salaries, will not be able to service their loans. So that will create a new NPA within the global scenario. Small companies, even in China, we are seeing a big issue with SMEs. So, you know, what I would urge is if the government looks at these models, China, for example, has told its banks that don't recognize an NPA for the next 1 year. They're giving companies 1 year to recover. I think some kind of mechanism has to be worked out globally. In the US, big companies are drawing down lines. Boeing just $13 billion out of credit lines that it had. Anheuser-Busch has taken out $9 billion. So all companies that can are just drawing down their lines so that they have liquidity. They are foreseeing a very painful next 6 months. And markets are smart enough to figure it out. So they have been hammering stocks and more the banking stocks. So yes, I see an NPA issue. I see banks suffering. I'm hoping that RBI and the ministry can get together and give some relief in terms of NPA recognition, especially for SME and the retail clients. That will be much needed. Distressed assets, it's a huge opportunity in India. And a lot of those projects, you know, if you take out what the crooked promoter had padded up and you look at the project itself, you know, my very good friend, he was doing one of the biggest steel projects. And the way they have turned it around, after with the new management, it's a gold mine. But it was suffering under that debt load, and the write-off was not that huge, but it was one of the biggest windfall gains for Indian banks. And my friend was the IRP for it, so I had a lot of discussions with him post this going through. Similarly, the two north-based projects, if you look at steel and steel power, are very good projects overall, saddled with bad debt and with good managements, they are turning around fast. So I think distressed assets, there's a lot of scope in India. We will have those funds coming in with multi-billions. If you look at, for example, any road asset you have or commercial real estate, there are a lot of funds available who want to just grab anything they can get in India, because there are no yields. And especially now with these new rate cuts, they are getting negative yields in their home countries. Some of them can even borrow at sub 1% and put that money into India. So even with the currency hedging, it's very cheap funds for them. And then if you can give them 8, 10, 12% on a real estate asset, they're very happy with it. And their leverage returns are very huge in their foreign currency terms. So distress assets, yes, NPAs will grow. Hopefully government and RBI comes with a package. China is providing a role model. Italy has said no need to make mortgage payments for next 3 months. It has told banks not to, and Italy has a bigger NPA problem than India's. So, if that government can take that tough call, I think it's a matter of time before we see something like that from our government.
Absolutely. Thank you so much.
Else anyone? Two participants raised hand. Please mute yourself and ask the question. Yes. Jai Gurudev.
Hi, I'm not very skillful on these finance subjects, but indeed I was going to sell an apartment, and I couldn't understand if you said that we shouldn't sell or if it was just on the market that you were speaking. Sorry. So this is Veronica from Portugal. Jai Gurudev.
Yes, Jai Gurudev, Veronica. Right now we are expecting real estate to suffer. So we are expecting globally real estate will come down because people will be in trouble with their jobs, with their cash flows, with their money. And in that sense, they postpone all big purchases. And real estate being a very big purchase, we are expecting prices to come down. I don't know the Portugal real estate market too well, but you will have to see that carefully. What is the kind of price you get? Because right now people are afraid for their lives, and no one will really buy a house or an automobile in that kind of a scenario. They'll wait it out. I hope that helped.
Sure. Yes, of course.
Thank you.
Jai Gurudev. Thank you.
Ajay ji, this is Krishnan.
Jai Gurudev Nurdin.
Jai Gurudev. So what I wanted to check was, we've had this depression across the world in 1929. Are we to be prepared for something like that, or it's not going to be as bad as that?
See, 1929 is very well understood. Mm-hmm. And it's amazing you asked this question, because the way this is emerging, it is more like 1929 than 2008. As I was saying, right. 2008 was financial contagion.
Yes.
So, liquidity dried up and it was more finance based. And that came into the real economy. Here the issue is real economy is in trouble, and that will lead to financial issues. So it's more 1929, if you ask me. Will it go as bad as that? Right now doesn't look like. And the big reason is in 1929-30, at the height of the crisis, all the central bankers went into austerity drives. They sucked out the liquidity. They tried to balance budgets. They basically choked off the markets, and it became a global depression. GDPs fell 25, 30, 40%. So, and for multiple years, and it took a world war to really take the world out of that entire depression. So those lessons are well learned, well documented. Ben Bernanke did his PhD thesis on 1929, and that's why he just kept printing money right through 2008 to 2012. Janet Yellen followed his footsteps, and that liquidity has not really gone out of the markets. And if you look at central banks, they're promising more liquidity. So that is one big difference. But the world has excess capacity. Till now, it was moving to China, and now we are seeing that anti-globalization. Same as 1929. All those emergence of totalitarian leaders, authoritarian leaders, very xenophobic nationalists, anti-globalization, all those are 1929 forces that are coming up. Big difference is central banks have learned their lesson. They know what worked in 2008. They are putting that stimulus right up front, and it's a huge bazooka. You know, $1.5 trillion Fed is putting in money markets, repo market every day, and 700 billion they have committed for the GSEC and the mortgage market. ECB has committed on top of nearly 3 trillion that they have put into the market since 2008. They have committed another 125 billion euros. So Japan is already at it. China put in $300 billion into their money market. So those lessons are very well learned. That could be the savior. Otherwise, situation is similar to 29. Very good question.
Yeah, I'm happy to hear that, because I mean, while we are probably staring at something similar situation, probably, you know, with the current, this century of, communication and more intelligence about the past learnings and things like that, I hope we would come out of this and will not be as bad as that.
Absolutely.
So,
yes.
Thank you very much.
Last two questions from audience. Mr. Jaydev.
Jai Gurudev.
Jai Gurudev.
Can I ask my question?
Yes.
Yeah, Ajay Bagga, anytime any financial problem, then government will pressure LIC of India and State Bank of India to find out for the same problem. In future, any problem with these two organizations possible or what? Anytime any problem, government will pressure either a State Bank of India, either a LIC of India to help.
That's true. That's a very, very good question, and it's a very pertinent observation. And we all hope not. But today only he was asking me on LIC that, you know, if too many people die in coronavirus and LIC has to pay so much claims, what will happen if LIC goes down? So I was explaining that, you know, insurers run on a very strict capital adequacy, solvency ratios. LIC settles every year 7 to 8 lakh death claims. So not that they don't understand it. And this portfolio of LIC, which gets, you know, it's the bailer out of the government of last resort. It goes and buys Indian Oil issue, whichever IPO is not working, LIC comes and buys IDBI, all kinds of things it is saddled. But it is still 15% of its assets under management. So LIC, it is a 53% market share of the total insurance industry. It has the government behind it. So if there is trouble, government can always print money and recapitalize it. But LIC is very well run. We don't see that coming through. Coming to SBI, again, one of the finest global institutions, unfortunately saddled with a lot of this work also. But the way it has come out over the last 5 years from its NPA issue, it has become quite strong now. And given its market share, given its technology, you saw the SBI cards IPO recently. They have a mutual fund subsidiary. There will be other subsidiaries. So SBI is like Government of India, basically. Again, worst comes to worst, Government of India is standing right behind it. You can print money and recapitalize. But your point is right. There will be a level up to which you can burden LIC and SBI. We have not reached those levels right now. And we'll hope that more market forces are brought in rather than burdening these two excellent institutions. So LIC, government has said that they would like to list LIC. It will get listed at 10 lakh, 12 lakh crore kind of valuation. So it's a huge company with very big assets. And both of them, their real estate itself, if you see, any city where you go, there will be the deputy district collector's residence. And next to that will be the LIC and SBI office. Huge real estate itself they have. So won't happen in the near future, but your point is very well taken. It's a very, very valid concern that all of us as Indians have.
Yes, thank you.
Intelligent question.
Mr. Amar Patil.
Jai Gurudev Bhaiya, Amar here.
Jai Gurudev.
Jai Gurudev. As a youngster, I want to ask, what is the best way to learn about investing and economics?
Start invest as low as 500 rupees. So put your money into something, and whether you make a success or make a failure, go for the lessons. So start investing. Read as much as you can. You must read a number of hours per day, and tens of hours per week. So read as much as you can. These days, you don't need to go to libraries. Everything is available online. Third, try to write. Writing really concentrates your mind. So there will be disparate pieces of information. How to convert it into knowledge into wisdom, and then action it. That's the whole chain that you have to go through. I'm saying short circuit that chain and start actioning with small amounts. Put 500,000 rupees, see how it behaves. Because once you are in the game, start seeing that price on a daily basis. No, Professor Subbarao won't need to tell you that go and check and tell me. You will see it yourself. And rest is sheer discipline. There are enough people, enough moments, enough events, enough sources who will teach you if you are willing to listen to them. I find it that I never have enough time to read all them by me. Don't read the same thing again. That's another way of saving your time. So if you're read up on Italian banks, for example, that's enough then. Don't read all the 6 articles might have come that day on the Italian banks. One is enough. You get the list, you start using that knowledge, go to the next topic. So deep in some topics and a very wide perspective across topics.
Thank you,
Thank
Bhaiya.
you. All the very best. All the very best.
Thank you, Sam, to clarify all the doubts.
Thank you. Thank you to everybody who attended. Very indebted to you for taking for this opportunity. Wish you all the best. Wish all the university all the best. Thank you. Jai.
Thank you.